Welcome to the Iraqi Dinar Update channel, your trusted source for the latest news, analysis, and insights on the Iraqi dinar. We provide up-to-date information on exchange rates, economic developments, and key financial trends affecting Iraq's currency. Whether you're an investor, trader, or simply keeping an eye on the market, our channel delivers accurate reports, expert opinions, and government policy updates to keep you informed. Stay tuned for real-time updates and in-depth discussions on the future of the Iraqi dinar. Foreign holders of Iraqi dinars who possess physical banknotes may encounter increased challenges when attempting to exchange their currency if Iraq moves toward a stricter fixed exchange rate policy. This situation could arise due to a variety of reasons, including governmental controls, currency regulations, and a shift in Iraq's monetary policy strategy. If Iraq enforces a fixed exchange rate, it could have several implications, particularly for those who hold Iraqi dinars with the expectation that their value will increase in the future. One of the primary concerns for foreign holders of physical dinars is accessibility to exchange mechanisms. Currency exchange depends on liquidity, market confidence, and the willingness of financial institutions to accept the currency in question. If Iraq establishes a strict fixed exchange rate and enforces capital controls, it may limit the number of authorized exchange points or create legal hurdles for exchanging dinars outside of Iraq. Banks and financial institutions, especially those outside Iraq, may be reluctant to hold or trade dinars if there are restrictions imposed on currency movement or conversion. This could lead to a situation where foreign holders of dinars find it increasingly difficult to convert their banknotes into other currencies, especially US dollars or euros. A fixed exchange rate system typically requires a country's central bank to maintain a stable conversion ratio between its currency and another anchor currency, often the US dollar. This system can be beneficial for economic stability by reducing volatility and providing predictability in trade and investment. However, it also limits the natural market-driven fluctuations of the currency's value. If Iraq's government and the Central Bank of Iraq, CBI, decide to maintain a rigid fixed exchange rate, it may discourage speculative trading of the dinar, thereby reducing speculative demand. Many foreign investors or currency holders currently hold dinars in anticipation of a revaluation or appreciation, hoping that an eventual policy shift will increase their purchasing power when converted into other currencies. For years, speculation around the Iraqi dinar has fueled discussions among investors, particularly those outside Iraq, who believe that the currency may significantly appreciate if Iraq implements major financial reforms, increases oil production, or gains stronger economic stability. If Iraq enforces a fixed exchange rate without any plan for an upward revaluation, this could directly counteract those speculative expectations. Such a policy would signal to the market that Iraq intends to maintain control over the currency's value, reducing any possibility of sudden or dramatic appreciation. This, in turn, could dampen speculative interest, as currency appreciation would no longer be driven by free market forces but instead remain dictated by central bank policies. Another critical factor affecting foreign holders of dinars is the potential for increased restrictions on currency repatriation. If Iraq enforces a fixed exchange rate alongside stricter foreign exchange controls, it could place limits on the amount of currency that can be exchanged or transferred out of the country. In such a scenario, those who hold physical dinars outside of Iraq may find that they are unable to convert them through official banking channels. This could lead to a situation where the only available options are informal currency exchanges, which often involve less favorable rates and higher transaction costs. Moreover, unregulated currency exchanges can pose risks related to fraud, counterfeit currency, or legal consequences in jurisdictions where unofficial currency trading is restricted. From a historical perspective, countries that have enforced fixed exchange rates have often faced challenges in sustaining them over the long term. Fixed exchange rate regimes require continuous monitoring and intervention by central banks to maintain stability. If external economic pressures, such as fluctuating oil prices, changes in trade balances, or shifts in global financial markets, exert significant stress on Iraq's economy, the country may be forced to reconsider its exchange rate policies. In such a scenario, a fixed exchange rate could either be adjusted periodically by the central bank or abandoned in favor of a more flexible exchange rate system. Foreign holders of dinars would need to closely monitor these policy shifts to assess their potential impact on currency exchangeability and valuation. For those who have invested in Iraqi dinars with the expectation of a substantial increase in value, a fixed exchange rate policy poses a challenge. Without the possibility of market-driven appreciation, the anticipated returns on holding dinars may not materialize. Some investors may attempt to liquidate their holdings, but if exchange restrictions are in place, they may face difficulties in doing so. Additionally, if Iraq prioritizes economic stability over speculative opportunities, it could discourage further accumulation of dinars by foreign investors who are hoping for a future revaluation. This shift in market sentiment could reduce overall demand for the currency outside of Iraq, reinforcing the effectiveness of the fixed exchange rate policy. Another consideration is the role of international financial institutions, such as the International Monetary Fund, IMF, in influencing Iraq's monetary policies. The IMF often provides guidance on exchange rate policies, particularly in emerging economies that rely on foreign investment and trade. If Iraq seeks financial assistance or policy support from international organizations, it may adopt measures that align with IMF recommendations, including exchange rate stability. This could further reinforce a commitment to a fixed exchange rate, making it less likely that the dinar would be allowed to appreciate significantly in the near future. Ultimately, foreign holders of physical dinars must navigate a complex landscape shaped by Iraq's monetary policies, regulatory decisions, and global economic conditions. If Iraq enforces a fixed exchange rate while simultaneously implementing stricter controls on currency exchange, it could limit the ability of foreign investors to profit from dinar appreciation. This would discourage speculative holding of the currency and shift focus toward the broader economic fundamentals of Iraq rather than expectations of a dramatic revaluation. In this environment, those holding dinars outside of Iraq may need to reassess their strategies and consider alternative investment approaches based on realistic policy outcomes rather than speculative expectations.